Hello, my CFA friends. How are you, my friends? Now, last night or yesterday afternoon, depending on where you live around the world, was a monumental day. And I couldn't help myself but have to provide an update on what happened and what I think is the reality and what I think will be happening in the future. So, as you probably know, we got a double rate cut from 5.5 Fed funds rate to down to 5%. So that's 50 basis points, what I would call a double rate cut, because normally you would expect to get 25 bips. Markets were in fact undecided. Most people thought initially we would get 25 bips, and then suddenly it became a 50-50 chance between 25 and 50 bips. And then eventually everybody was expecting 50 bips. And Powell did come out and oblige the market, did not disappoint the market by indeed providing a 50 bips rate cut. For those who don't know, the Fed was created in 1913. It's the Central Bank of America. So I like to think of it as a central planner that controls interest rates. And interest rates, of course, are the cost of money. Whose money? Your money. So let that sink in. There is somebody out there who controls the cost of your money. That's the Fed. They have a dual mandate. So they are looking at price stability and they're looking at full employment. And price stability in recent past has been defined as inflation under 2% per annum. So what did Powell say? Well, he said inflation is making good progress towards the 2% mark. I'll tell you what I think about that in a minute. But obviously, he was happy that we are on a downward trajectory when it comes to inflation. And for that reason, he's now shifting his attention a little bit away from inflation. And he did say he's not declaring victory, but he's shifting his attention a little bit away from inflation towards the labor market. And he says the labor market has somewhat cooled down. And again, I'll tell you what I think about that in a minute. But is the Fed late to the party? What do I mean by this question? Well, guys, they started increasing rates in March of 2022. Okay, so more than 2 years ago, they started increasing rates. But at that point, inflation was already at 8 or 9%. So obviously, they started increasing rates quite late. And they managed to keep rates at 5.5% for 11 or 12 months, which, to be honest with you guys, is not a long time. So for a major economy to be unable to keep rates at 5.5 for more than a year, that's quite worrying in my opinion. But also the fact that they're starting with a 50 basis point rate cut, that to me does not bode well, okay? If everything was under control, why would you not be able to keep rates at the current rate for longer? Or indeed, just start with a 25 basis point rate cut? I don't think situation is under control, okay? What else was said? Future direction of interest rates. So that's in their summary of economic projections that they publish, I believe, quarterly. So the September issue is out now. You should check it out. So what are they saying? This is the 19 Fed members, of course, making their own projections of the future. So they talk about inflation and unemployment and GDP. And of course, interest rates, the all-important interest rates. So they're expecting 2 more rate cuts in 2024. I believe there are 2 meetings remaining anyway. So if we're now at 5%, you do the maths. I'm guessing 25 bips rate cuts for the next 2 meetings. That will bring us down to 4.5%. And in fact, the median Fed funds rate expectation for 2024 is 4.4%. And then they're also expecting additional 4 rate cuts in 2025. Again, I'm guessing 25 bips is on their mind, of course, unless something happens. And I think something will happen, but okay. So 4 times 25 is another percentage point. So we come down to 3.5% by end of 2025. The median forecast 3.4%. And then the kind of neutral interest rates, i.e. the interest rate that neither cools down the economy nor heats up the economy in the longer term, they're looking at a number around 2.9%. And again, I'll be telling you what I think about that number as well. Now, you guys can't really understand what's happening unless you're keeping an eye on debt and deficits, okay? So we could all be sitting down here talking to each other all day long, debate, and your opinion is different from mine, and your political affiliation is different from mine. But there are some facts that we cannot debate or ignore. So cash is king, so we can look at the numbers. What's the debt and the deficits? U.S. national debt, I just checked it, 35.4 trillion. I can't even imagine what that number looks like. I don't even know how many zeros are in a trillion, but that's the debt number right now, the national debt. Now, even more worryingly, let alone that we've got a pile of debt here, but their budget deficit for the month of August, so pretty recent number here, the budget deficit came at 380 billion. So for those who are still practicing their economics, deficits arise, fiscal policy, right? If we've got more government spending than taxation, we've got a deficit. So they clearly spent more than they received in taxes by amount of 380 billion. Now, I did some quick and dirty computations here. If you annualize this number, and I grant you, obviously, this is just a single month, a point estimate, so obviously it could be lower or higher in another month, but if I just annualize that number, I'm getting 4.5, more than that actually, 4.5 trillion annual deficit. So what that basically means is if I take this number here and I add this number, I'm going to be looking at very, very soon 40 trillion in debt, my friends, in the United States of America. Thirdly or fourthly here, I can also think of this number 380 billion as 1 trillion being added to the debt every 3 months. It's actually 80 days, but okay, let's call it 90 days, every 3 months. So Uncle Sam is actually adding a whole trillion of debt every 90 days, okay? So the clock is literally ticking, 35, 36, 37, and so on. And I also wanted to perform a quick back-of-the-envelope computation here. So remember here, they told us that the Fed funds rate is going to come down to 2.9%. So let's just kind of assume that they can borrow, although Fed funds rate is not the rate at which they can borrow necessarily, but let's just assume they can borrow at 3%. So let's see what happens here. So I can borrow at 3%, and we said that in a year's time, my debt will be at 40 trillion. So I'm going to take that number here. And if my math is not mistaken, that's going to give me 1.2 trillion in interest per annum. Let that sink in, my friends. Now, if you actually look at the major expenses that Uncle Sam is incurring every year, I would say probably very, very soon, interest on their debt will be the biggest expense. I mean, just think if you're a household and your biggest expense was interest on your credit card or your mortgage. I mean, well, I suppose mortgage could be your biggest expense, but again, if you're spending a significant amount of money on interest, then you're probably being squeezed out significantly. I also wanted to look at a bit of history. So we've begun the rate cutting cycle with a 50 basis point rate cut. Okay. So I wanted to go back and see when in the past they've done that. So 50 basis point rate cut, they did start the rate cutting cycle with 50 basis point in January 2001. So they cut from 6.5 to 6, and then another 50 basis rate cut as the initial cut in September 2007, when they cut from 525 to 475. Now, a quick pop quiz, if I may, guys. Look at this today's January 2001 and September 2007, and think if you maybe know that something happened around that time. Do you remember perhaps anything? I don't know how old you are, but I mean, do you remember anything happening around those dates? Or maybe you've heard about it. And if you don't know the answer, I'm sure you do, but 2000 was a bad year for tech stocks. We call that the dot-com bubble burst. And yeah, there was a crisis and markets did tank a lot. And then September 2007, of course, was the prelude to our beloved GFC, or the global financial crisis. So again, what I'm saying is maybe they are late to the party. Maybe something's already broken. And they're now like, oh my goodness, what am I going to do? I have to cut 50 basis points. Late to the party. Maybe crisis brewing, maybe crisis has already happened. Certainly, it has happened in the past. Now, I want to go back to that issue about inflation making good progress towards the 2% mark. That's kind of what Powell said. So remember, the Fed defines price stability as inflation under 2%. That's at least recently how inflation was defined, or price stability, and that is their mandate. They need to keep prices below 2% or inflation below 2% to show that we have nice, stable prices and no serious worrying inflation in the economy. Okay, well, let's have a look. If we've got inflation under 2%, and bearing in mind that we are using the government statistics. Now, of course, they've got a lot of different ways in which they can weigh the different items in the basket to understate inflation. But okay, let's just believe these numbers for now. Let's have a look at the headline CPI. Remember, headline includes everything, including the so-called volatile items of food and energy, because you don't have to eat and you don't have to use energy. So headline CPI is 2.5%. And then core CPI, which excludes the volatile items of food and energy, is actually higher at 3.2%. And okay, let's start with the obvious elephant in the room. Is 2.5 less than 2? Let me think about that. Not quite. 3.2, not quite less than 2%. Now, of course, you're going to tell me, yeah, but Powell didn't say it's below 2%. He said it's heading towards 2%. Okay, but it is not stable prices, right? 2.5 is not under 2. 3.2 is not under 2. So we don't have stable prices. That's the first point. Second point, can you see that the core CPI is actually higher than the headline CPI? That's quite unusual. And why is that happening? Well, because core CPI must have excluded the volatile item of energy, of oil prices. And actually, oil prices are playing ball for now. What I mean by that is oil prices are under $70. This is cheap, my friends. Oil is a bargain right now. Now, you know, obviously, the geopolitical situation in the world. If this heats up, oil goes up. Also, we have a relatively strong dollar still, but once interest rate starts declining, the dollar will lose power. We are currently holding at a support level of about 100. That's for the DXY. Easily, if that loses support, we are down another 10% from 100 to 90. And a weaker dollar definitely means stronger commodity prices. Stronger commodity prices mean higher inflation. So that's coming. Okay, but also I went a bit further. I didn't just look at these numbers here, but I actually read the report and I wanted to see what's under the hood. And I saw these numbers, right? So this is most recent report. Car insurance year-on-year plus 16.5%. I don't know about you guys. I mean, unless you live in central Manhattan and you don't need a car, most people actually need to own a car. And it's a legal obligation to have insurance. I don't know about you guys, but car insurance going up by 20% a year is pretty painful, and I wouldn't consider that price stability. Transportation, let's think about it. Do you ever travel anywhere? Do you go on holiday, or do you just get a train sometimes? Transportation up 8%. Not price stability. Rent. Do you rent, guys? Do you have to live somewhere? That's an interesting question, right? Do you need to live somewhere? Well, that's gone up by 5%. Electricity. Do you guys ever use electricity? Do you use lighting at home or maybe aircon? That's gone up by 4%. That's not price stability. And medical care. Do you ever get sick? Okay, that's gone up by 3.2%. And you might say, well, 3.2%, that's nearly price stable, right? Well, it's more than 2%. So then I wanted to go to the other point he was making. Is the labor market just cooling? So he said it is cooling, right? Unemployment, I looked at that number, that's 4.2%. And obviously, we always have to look at numbers relatively to other numbers. Well, it's the highest since October 2021. So again, if you're thinking about the pandemic, if you're thinking about your government telling you, well, you have to stay home and not go to work, that was a pretty bad period, right? And we are at unemployment levels kind of around that time. Let that sink in. Yeah, but the market is just cooling down. U6 number, that's another number that you might want to have a look at. So obviously there's the official unemployment number, which is 4.2. And then there's this U6 number, which is a broader measure of unemployment. I like to also have a look at this number because it's going to include a broader definition of what unemployed is. So the traditional unemployment number, I think the U3 number they call it, basically includes people who are actively looking for work. So it excludes people who may be working part-time, but want to work full-time and they simply can't find full-time employment. It also excludes discouraged workers, and so on. Whereas the U6 number will be including all that. So it would include discouraged workers, so someone who's basically been out there looking for a job, can't find a job, and basically kind of gives up. So that type of person will be included in the U6 number, and the part-time workers will also be included in the U6 number. So the part-time workers who actually wanted to work full-time. That number, guys, is at 7.9. So it's pretty scary, right? 8% of people are unemployed. Also, I wanted to look at the jobs reports, the so-called NFP or non-farm payrolls. Well, guys, in July, we got a number, and these numbers just keep getting revised down to the point that you cannot trust them anymore. But okay, they have been revised down now. So let's say we can trust them a little bit better. And the July number was revised down to 89,000, which was the lowest since pandemic days. Okay, so the economy added just 89,000 new jobs in July. And that was the worst number since, again, lockdowns. Let that sink in, my friends. And also, they came out and they revised all prior NFP numbers for the past 12 months, for the past year, down by 818,000. I mean, how do you run your maths? How do you run your statistics so that you actually are forced to have to revise something down by 800,000 jobs. It's bizarre. And I also wanted to finish here by talking a little bit about the stock markets. I had a quick look at what the stock markets are doing, right? S&P 500, broad-based market index in America. And obviously these numbers are changing continuously, but at the moment it's 57.45, and that's a new all-time high. Nasdaq is tech heavy, 19,658, down 5% from its all-time high at the moment, and Dow Jones 30 also at a new all-time high. So markets are really bursting, okay? And you can also think of this as inflation, okay? It's not inflation in the sense of your rent's going up or your transportation or electricity is going up or your medical bills is going up, but it is asset inflation. And of course, nobody complains about asset inflation as long as you've got assets, right? Many people don't have assets, but okay, let's say you've got assets. Don't complain about asset inflation. But I mean, you are starting to cut interest rates with markets at an all-time high. I mean, just ask yourselves, how healthy is this economy? If you have to start cutting rates when markets are at an all-time high. And not only that, but you're starting to cut rates by an initial rate cut of 50 bips, which we saw is kind of generally associated with dot-com type of situations or GFC type of situations. So the reality, guys, and I want to keep this very, very short, but the reality is at $35 trillion of debt and deficits that are going to be mind-boggling, $4 trillion a year. You simply cannot afford to service that debt, to have the debt and to service that debt. Now, the deficits aren't going anywhere. The debts aren't going anywhere. They're going to continue to climb. But the point I'm making is you're not going to be able to service this debt. And what they're saying there, 2.9% long-run rates, well, I'm afraid that's not possible. I mean, rates, of course, should be higher. I'm not saying rates should be at zero, but I do think that rates are eventually coming back down to zero simply because Uncle Sam cannot afford to pay the bills. And the bigger worry that I have is not that rates are going to go down to zero. Of course, if you've got a mortgage or any kind of loan that might benefit from the Fed funds rate going down, of course, you are celebrating right now. The real problem is going to be inflation. If anybody is going to tell you inflation's under control, inflation's going to be going down in positive way, under 2%, they're lying to you. I'm sorry, guys, they're lying to you. I think inflation is going to be a big problem for us, and it's going to become a much bigger problem now that the rate cutting cycle has begun. The problem also that we are having is that the labor market, I don't think, is very strong, and I don't think that the 50 basis point rate cut is going to do very much for the labor market. So the labor market is going to keep worsening. Inflation is going to keep worsening, aka stagflation is coming. I don't want to scare anybody. I would be humbled to be proven wrong, but let's wait and see. And that's all I wanted to say in today's video. Obviously, this channel is dedicated to CFA tuition, so that's kind of a bit of an unrelated topic. But if you're studying for economics, obviously you've got your monetary policy, your fiscal policy. So I wanted to put all that to life. Also, I want to remind you, please support me, guys. I need your support. You can do so by going on stoyanov.co.uk, signing up to my CFA Level 1 revision product. Thank you very much for watching, my friends, and have a great day.